Okay, the purpose of this video is to show you how to do Unit 4, Activity 2, Transaction number 3. So far, we've done Transaction 1 and 2, and now we're on to 3. This one is a different style of adjustment. This is a salary or wage adjustment, and this falls under the category of accruals. And you can read more about that in the content section of our lesson or in the textbook. All right, so the first thing that we need to do for this one is we'll take a look, we'll read it, and then we'll figure out how much the employees are owed since the last payday. So we are at the end of the month, July 30th, and their last payday was July 23rd. So if we look at the actual scenario here, employees are paid $2,400 every 2 weeks. All right, so if they're paid regularly like that, a regular amount, that probably means that they're on salary. A salary is the amount that you get paid for an entire year. So you have a certain amount that you get paid no matter what, no matter how much work you do or how much work you don't do. You get paid in regular increments and you get paid the exact same amount every time. Wages, on the other hand, are different. Wages are typically doled out differently every pay period, depending on how much you worked. So if you start getting jobs in high school or after high school, typically if it's like a service job or kind of a minimum wage style job, maybe you're working at Starbucks or Tim Hortons or something like that, you'll be paid wages. So you'll work 20 hours a week, 23 hours a week, 26 hours a week, 30 hours a week, whatever it is. And based on the number of hours you work, that's how much you'll get paid. So those are wages versus salary. So in this case, in our example here for transaction 3, it looks like the employees in question are salaried employees. They get paid the same amount every 2 weeks. And in this case, it's $2,400. And so the second part of this asks us to make the adjusting entry for July 30th if the last payday was July 23rd. All right, so we're making an entry for July 30th, and there is a week's worth of work that the employees have done, but they just have not been paid for it. So we want to make a record of that just so we're not carrying forward the wrong balance or making financial decisions based on the wrong amount of money that we have, because we owe our employees a certain amount of money, even though it's not quite reflected yet on the books. That's why we're making the adjustment. We want it to be reflected on our books. So we're going to put this in our journal. All right, so the first thing that we want to do for this one and ones like this is we want to determine how much the employees are owed since the last payday. So in this case, like I said, July 23rd to July 30th is 1 week. And if they're paid $2,400 every 2 weeks, then all we have to do to determine the amount that they haven't been paid for the 1 week is divide that $2,400, that $2,400 by 2, and then we'll figure out how much they make in 1 week. So luckily that's pretty easy math. I probably don't need the calculator, but I'll bust it out anyway. 2,400 divided by 2 equals 1,200. So the employees at this business are paid $1,200 every week. And so we have our amount now that we're going to put in our journal. We just now have to figure out under what accounts we actually want to put it in. And so our first account is going to be our debit account. And we're going to put it down here next to the June 30th. And this is going to go in under salaries. I got to spell that right. Salaries, expenses. And that's going to be a debit for that amount that we found earlier, which was $1,200. And so just like our previous 2 transactions, we're making note of this in an expense account. This is money that will eventually leave our business and will no longer be counted as part of our equity or our owner's equity. And so the expenses category is where we do that. Again, it's a debit because anytime you're adding to an expense account, you debit it, right? And then the second, since we have a debit, we also have to have a credit. Hopefully we're getting used to that idea. And the credit is going to go in the wages payable. The wages payable account, and that's also going to be for the $1,200. And the wages payable account is much like the other payable accounts that you're used to. This is money that we will eventually be paying out to somebody, whether that's another business or a vendor or a client, or in this case, our employees. And sorry, so I said wages payable, and we talked about how in this example, these employees are probably salary employees, so it'll probably be salaries payable. And then we've got our indent there so that we know it is a credit, right? So that is how you do the salaries or wages accruals, adjustments. And then on the third line, sorry, I almost forgot that. We just have to put our description of the transaction or the adjustment. So to record employees accrued wages owed to our employees. All right, so that's it for transaction 3. I will end this video and we'll move on to transactions 4 and 5. They are the same style of transaction, so we will be able to get those done in the same video. See you then.